All right, guys, it's 4:01. We'll get rolling with the call here. So, good afternoon, everybody. Let me first start by saying thanks for joining us for our first quarter 2024 market update. We recognize everyone's busy. You're taking time out of your day, so we're gonna try to keep it to about 25 minutes or so. If you do have questions, use the chat feature, and if we do have 5 minutes or so left, we'll address a few questions. If we don't have time, we'll take those questions and we'll get back to you one way or another. But with that being said, I'm Brian Reese, certified financial planner with Raymond James, CKE Financial E&M Consulting. And today I'm joined by fellow CFPs Scott Jones and Ryan Eierman. And the rest of the team in the photo, some of which you may know, we've got Tim Eierman, John Lippi, Davia Sweeney, Tanya Dyke, and Julianne Gardner. So that rounds out our team. And we're located right here in Crocker Park in Westlake. And we help clients with personal financial planning needs, but we also help our corporate clients with their retirement plans. So currently we're managing about 75 retirement plans or so. And really what we're talking about there is company corporate 401k plans, cash balance plans, 403b plans. So again, we're helping people both on the individual side as well as on the corporate side of things. Remember, use that chat feature if you have any questions for us throughout here. But whether you're an individual client or one of the corporate clients, really the key here is just so that you know that you've got many tools, many resources at your fingertips. So just a couple of examples, though. Every Friday, Ryan sends out a market update email to clients. If you're not getting that and you want to, again, let us know. We'll add you to the email distribution list. But it's a good quick read on Friday afternoons. If you've got individual business with us, using the Raymond James app is a great way to track your personal investments. And then we encourage most clients, not necessarily all, but most, to have us run a financial plan for them at some point. Now, if you are a corporate client and you want us to come out and do 401k education meetings, we're happy to do that. We try to stay on a regular schedule with that. If you do have an immediate need, by all means, just let us know, and we'll be happy to come out and work with you and work with the employees. So for today's agenda, I'm going to talk about the market update and some of the key themes. I'll turn it over to Ryan Eierman, who's going to cover the stock market outlook. And then Scott's going to take us through the fixed income outlook, along with a little talk of interest rates. And just a hint there, think longer or higher for longer is kind of the theme with interest rates. And then I'm going to wrap up by sharing a pretty exciting seminar that we're going to be hosting in May around Social Security. So we'll circle back to that. But for now, that's it. So we'll dive right in here. This is a page with a lot of information on it, but I think the summary to it, I'll point out a couple of the numbers, but the summary is we saw a familiar pattern that's been around for a little while, where U.S. investments outperformed developed international outperformed emerging markets. Large cap companies outperformed mid-sized companies, and mid-sized companies outperformed small companies. Growth still outperformed value, and AI remains a dominant mover within the market. So those are the same themes that we've been talking about for a little while, and the first quarter really just repeated that for us. And remember, if you're in a diversified portfolio, that's all good and well, because in a diversified portfolio, you're using all of these different asset classes. Scott's got our popular quilt page that shows you the best performing asset classes. But as long as you're diversified, you're invested in all of these. So that's good. Returns, the Dow Jones Industrial Average in the first quarter, right there, top line middle. The Dow returned 5.62, making the 12-month return close to 20%. The S&P 500, which is the widely used, widely cited source for people to look at to gauge the overall investment climate in the U.S. The S&P had a fantastic quarter, up 10%, which puts the 12-month return at about close to 28%. And then the tech-heavy NASDAQ, close, a little bit north of 9%, or about 34% over the last 12 months. So some good moves in the first quarter. Any statements should look pretty darn good. Just to give you a quick glimpse as far as where we're at now, as I said, the Dow at the end of the quarter, 39,807. Dow today, it's down on the quarter, down 38,239. S&P at the end of March and the first quarter is 5254. Today we're down just a bit above 5,000, back above 5,000. And then the NASDAQ is at 15,451. So that's also down in the second quarter. Remember, this is end of the first, and I'm talking about today. So second quarter, we're seeing a little downturn in the market. The next section with the different rates, the one that jumps out at me is the 30-year mortgage. Average 30-year mortgage, somewhere in the 7% range still. I heard a stat today that all sales of homes in Metro New York north of $1 million, or 60% of all the sales in New York City above $1 million were all cash deals. So I think up market, more real estate is getting done with cash. For the rest of us in the country, though, yeah, we're dealing with about 7% rates. Scott's going to hit on that investment quilt with one of the asset classes is commodities. So when a lot of us think commodities, we think of the two biggies, gold and oil. So you can see the first quarter return on gold down here towards the bottom was about 8%, while crude oil was up about 16%. We won't get into this now, but we don't have Bitcoin on there. But Bitcoin, in some ways and in some people's eyes, view it as an alternative to gold and an alternative safe haven. Pretty volatile, not widely understood by a lot of people, but that's another asset class that we do look at. Over on the right-hand side, this is showing the different weightings in the S&P 500. No surprise that the fourth one in the overweight section, fourth one down, is information technology, making up close to 30% of the S&P 500. So Ryan will hit on a little bit about that in a few minutes, but you can see how heavily weighted the S&P is to information technology at this point. So again, just kind of interesting. But those are the overall returns on the quarter and where things were at the end of March as well. As far as the key themes, and I'll cover a couple of these, and Ryan will get one as well. But and Scott will talk about the interest rates. But really on this page, and everybody will get this presentation, by the way. We'll send this out to everyone as well, because I know it's probably not super easy to read. But the four themes are the post-COVID economy. Number 2, after the Fed pivots. Number 3, food for thought. And number 4, this isn't your father's index. First one with the post-COVID economy, interest rates went up so much over a 12 or 18-month period, trying to bring down inflation. Hasn't done a great job of that. So, that Scott's going to talk about what the Fed is doing, but that's one of the main drivers. One of the big pieces of our client conversation is what is the Fed doing? How are we handling interest rates, and how is that helping or trying to battle inflation? Food for thought, I'm going to talk more about, but that one is something that's in all of our faces when we go to the grocery store. So it's kind of interesting what's happening behind the scenes, but we all know that going to the grocery store, food prices are still high, but not as high as they were, but we're still dealing with that. And then the last one, not your father's index, is just talking about how AI is affecting the S&P and driving the S&P. And Ryan's got the Magnificent Seven slide that he's going to talk about. On the right-hand side is just a quick visual as far as an outlook goes on the different asset classes. Big picture is what do we think on equities, and then underneath that is large, small, developed, and emerging markets. Neutral is that gray line kind of right down the middle, and then fixed income, investment grade, high yield, and emerging market debt, and then commodities and cash. So again, quick visual. Gray line down the middle being neutral. Anything to the right is a more positive outlook. For instance, investment grade bonds and fixed income, more of a positive outlook than developed international markets. Some of these slides hopefully look familiar because that last one, that's one that we use all the time. So we use that sort of slide when we're doing a 401k plan review. We update these every quarter. So hopefully that one looks familiar. And then we've got some other ones that we pull in, more timely pieces. This is that food for thought one though. Again, I know we all go to the grocery store. Prices that we pay at the grocery store were a lot higher in COVID and just outside 2020, 2021. 22, and now we're seeing some normalization at the grocery store. I don't think we're ever going back to where we were, but we're seeing some normalization. What this slide is talking about is food prices. So when people are buying and selling corn and wheat, so those sort of things, the food prices are down as well. I don't think that necessarily is translating to our grocery prices, not yet, but that matters to big picture in the commodities market when those things are coming down in price. So we're not yet back to pre-COVID levels though. I'd say the big thing there when we talk about food inflation is exactly two components. One, how much are the grocery stores paying for food, but then also overall inflation and purchasing power. And as we battle inflation and the Fed tries to battle inflation, hopefully we see a little bit more relief. But it's going to take a while. It's going to take a while. So with that, I'm gonna turn it over to Ryan. And as I mentioned, this is kicking off with the Magnificent Seven, but Ryan, it's all yours.
All right, thanks, Brian. So yeah, this is a slide that goes back to 1998 through present, and this is basically looking at the market capitalization of the S&P 500, and as you can see, it's just above 30% in terms of the Magnificent Seven, which are the major tech stocks in the United States: Microsoft, Amazon, Meta, NVIDIA, Apple, Tesla, and Google. And even more so recently, it's become more of what they're calling Fantastic Four. Apple, Tesla, and Google have sort of been lagging behind the others recently. But that's where the majority of the growth in the S&P is coming from currently. Majority of the returns. Okay, moving on. This is another one of our favorite slides to share. This is the S&P 500 going back to 1980. JP Morgan tracks the intra-year low point of the market compared with the end of the year where the S&P 500 finished up. So as you can see, the red points that show up each year is the intra-year low where the market bottomed out for the year, and then the gray bars above are where the market actually ended up finishing up. So for example, if you look at 2020, you can see that during COVID, we had a low point of negative 34%. Despite that, the market finished up 16% that year. This year, the low point has been negative 2%, and year to date, we're up at 10%. So this really is mainly a positive outlook, and it really shows that the market, despite a lot of volatility sometimes, it ultimately finishes positive 33 out of 44 times, 75% of the time. So another interesting stat, this one sort of contributes to why we are now having a more positive outlook for the remainder of 2024. But so if you look at the chart on the left here, this is the average of the S&P going back to 1926 when compared with the returns of January and February. So when January and February were positive in the markets, we saw an 11.1% return. And then going back, looking at the last 34 years where there was a positive January and February in the markets, we only saw 2 times when the remainder of the year finished up negative. So statistically speaking, we're optimistic that that trend is going to continue, and we'll see a positive finish for this year. So this slide is our base case and our bull case prediction for where the S&P is going to finish up for the end of the year. We are currently right around, as of earlier today, the S&P was at just above 5,000. And both, I will say that both our chief investment officer and our chief economist at Raymond James have recently updated their base case to 5,200 for the end of the year. So at the beginning of the year, we were expecting the S&P to finish up around 4,850. That's now been adjusted up to 5,200. And that's based on a couple things. The expected rate cuts, consumer spending has remained strong. There's been the government stimulus packages such as the CHIPS Act, the Inflation Reduction Act, as well as the infrastructure spending going on as well. And then if you look over at the chart on the right here, this is another interesting chart that looks at the impact of once the Fed starts to cut rates. So we're expecting the Fed to start doing that this year. Early June, I believe, is when they said they wanted to start. So this is looking at 10 Fed rate cut cycles going back to 1974. And you can see that the average result of those rate cuts was about, from the time they start cutting to the end of the year, it's about a 5% return in the markets. So that's kind of what we're expecting from this point. If the market's at around 5,000 now, kind of expecting a 5% return by the 5% growth by the end of the year. And then with that, I'm going to go ahead and pass it off to Scott to talk about fixed income.
Great. Thanks, Ryan. Appreciate everybody signing on for us. The bond market has been, it's been interesting. It's been kind of like I would say the weather a little bit in Northeast Ohio. All jokes aside, but it's, you wake up and it's 40 degrees and there's frost on the ground, and by this noon it's 70 degrees out. So it's just, this has not been typical. If you look at this chart, this is going back 48 years of bond returns. Usually we're expecting pretty stable. 43 out of the 48 years have been positive gains, average of 6.6%. If you look at all past the last 48 years, there's really only 3 negative years. And we've had 2 negative years in the last 3. So when we started off the first quarter with down 1%. So, it's been difficult, especially for our senior investors who are going to have more fixed income bond exposure than maybe somebody that's younger with more of a growth profile. So, we have retirees, they're on a fixed income and they're expecting income from these assets. And so, it's been a difficult the last couple of years, and that's largely due to the interest rate environment. I think the good news is that as we move forward, the returns for bonds look a lot more positive. And if you remember the outlook that we had when Brian was discussing, we had a positive outlook on the fixed income chart. And that's what we expect. The market expects the Fed and interest rates to come back down. And so when interest rates drop, there'll be a price increase to the bond prices of the underlying bonds. So they kind of have an inverse relationship. So we saw a huge spike up late 21 into 2022, basically going from 0.25% to upwards of 5.25%, which has been, had an inverse relationship. And you saw that negative 2022 fixed income return close to 13%, which was the worst in 50 years. So we expect that to start to reverse itself. Now, inflation has been a lot stickier than I think the Fed would have liked. There's just certain things that are not coming down in price, and they're looking to see that before they move. But this chart is just kind of representing what the market expects Fed funds rates to be at in the next couple of years, getting much closer to a 2.5, 2.6% long-term projection, which would kind of match, tie up with inflation, average inflation, things like that. So, the good news is that money market rates are paying 5+%, and CDs at the bank are now in that range, which they had been at 0 for many years, even over a decade since the Great Recession in 2008, 2009. So we expect those to come back down, though. So it's important that you think about that opportunity cost, because people are feeling really good in those safe money market funds right now, but will there be a missed buying opportunity when they drop and not having the opportunity to purchase bonds and things like that at that time? So you need to consider that moving forward. We talked about the quilt chart. This is just the returns of asset classes over the last 15 years. You can see that on the far left, the large cap box of 14% represents the S&P 500 index. That's a 14% return on average each year from 2009 to 2023. So it's by far been the best returning place to be. And even still, year to date, up through the first quarter, 10.6% on the far right. As Brian mentioned, if you look at the gray box, DM equity stands for International Developed Market Equity. The average return there has been 7.4% each year. So the U.S. markets have almost doubled what our large US international markets have done. And, we've tried in our portfolios in the 401k, as well as our Freedom portfolios at Raymond James, to take advantage of that. It's one way we've been able to have some success. Otherwise, you know, asset allocation, the white box in the middle, that's kind of representing diversification. You know, long-term investing, you want to spread your money across all the different colors. It's a much smoother way to achieve more stable results and grow your account for retirement and long-term goals. The only other thing we'll point out is commodities. You know, people do get excited about that. 2022 was the best performing. It's a dark green box, up 16.1%. But if you look at the very next year, 2023, it finished at the bottom. You know, so this is the kind of, you want to buy low, sell high. You know, people they end up buying high, and then they watch it be the worst performer the next year. So long term, over the last 14 years, commodities have finished last. Bottom left box is barely broke even. And that commodity is a makeup of oil, gold, materials, timber, et cetera, that make up the commodity index. So think about that as you're making decisions. You know, always, for those of you in our employees in our 401k plans, you know, we do make available Raymond James portfolios. You know, that's a really good way to kind of invest for the long term. There's also a lot of times what are called target date mutual funds, which are investing towards a specific target year or decade in retirement. It's two great ways to invest for long-term goals. Please reach out to us if you have any questions of how to find those, or if you're not in the right place. We're happy to talk through that with you. We also provide a portfolio questionnaire. This is for, you know, helping you determine your risk preference. If you're not sure, you know, where you're at or how much risk you should be taking, you know, we can walk through this with you and answer these questions. And you know, it's based on a time horizon of how many years you have till retirement, as well as a preference for risk or comfort level with investing. And we would help guide you to the appropriate 401k portfolio on the 401k side, or the freedom portfolio on the wealth retail side. So appreciate opportunity to talk to you today, and I'm going to hand it back over to Brian, give you an update on a presentation we're hosting next month on Social Security.
Yep. Awesome. Thank you, Scott. Yep. And I'll just wrap it up real quick in a minute or so. Make sure everyone knows that Tuesday, May 14th, we're going to do this Social Security. It's going to be, if you want to register for the Zoom meeting, you can do that. We're going to get the link out to everybody to register for it. We are also opening it up to people if they want to come in person to join us for physically and for a luncheon. We're bringing in a Social Security enthusiast. I would call him an expert, but compliance doesn't allow it. So Social Security enthusiast who knows the Social Security system inside and out. So if you're 55, 60, 65 years old and you're thinking, I don't know when to collect it, I don't know how much I'm going to get. If you want to see a break-even analysis, anyone that's divorced, remarried, older spouse, younger spouse, there's a lot of different things that go into it. So we're going to take an hour to go through the basics and then get into stuff that's a little bit more complex, but yet very common. So meeting link will come out to you soon. And then again, choose to do it virtually or come and join us at the Crocker Park address. So I'm gonna click one more slide just so you have all of our contact information. Let me see if I can go to the next. There we go. Okay. So take a second. You can reach out to any of us. We're more than happy to help. Again, whether you're in a 401k plan or not, we can help you answer any questions, help you with your overall allocation, give you an update on the markets like this again. Remember, we do these quarterly, so join us again early third quarter for the second quarter update. With that, I think we're right at 4:30. So there might be a couple of questions that have come through, but we're going to probably get off here, let you guys get back to your day. We appreciate everyone's time. Look forward to helping you out. Reach out to us if you've got questions. Get out there and enjoy the sunshine. Thank you.